Right now, the stock market is really volatile. So what is a little trader to do? Do you trade and try to take advantage, or do you just get out? We're going to talk about how to answer that question for yourself coming up next. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and create a retirement from nothing. Well, if you're trading the market like I am, right now it's incredibly volatile. There are people out there who say, oh, you should get out, protect yourself. There are other people saying, oh, now's the time, get in there, take advantage, there's great deals to be had. So what are you supposed to do? And the way I trade is really speculative. And if you trade like I do, there's a possibility you could lose all your money. So don't listen and think I'm some kind of expert. But I am going to tell you what I do in a volatile market and how maybe you can navigate that market for yourself as a small trader. Now, the first thing to understand is when the market gets really volatile and it starts to swing, or a particular set of stocks or sector starts to really swing up and down, that volatility changes things. Now, if you're investing for the long term and you're planning to hold stocks for a year or more, it really doesn't affect you much because that intermittent volatility isn't what you're worried about. You're worried about the long-term gains. But the way I trade and the way a lot of day traders and swing traders trade is they're in it for short-term gains. They're trying to really beat the market in order to build their account to one day invest for that long term. But you got to have money to do that. So a lot of us are trying to maximize our returns with our small accounts, and a volatile market can be a good opportunity to do that. But there are a couple of caveats. It is not suited for everyone. In a volatile market, if you cannot sit and watch the market while you have an open position, you should not be trading in a volatile market. It moves too fast. If you have a day job and you can't know for certain that you'll be able to trade exactly when you need to trade, you should not trade a volatile market. If you do not have a great internet connection, or you have an issue with connecting in a timely fashion, you should not trade the market when it's volatile. These are just precautionary things to know that when that market's volatile, you got to be on it, man. You can't be piddling around and hoping maybe your price will get there. It goes up and down so fast, it can get you in trouble really quickly. So the first thing you need to be aware of is you have to sit on that market. You have to watch it, not just put in a trade and walk away. You have to be able to watch it. And if you can't do that, then it's not for you. Just sit on the sidelines and wait for a better opportunity. There will always be one. It's not like you're missing out. There will always be another opportunity. So if you're in that category where you can't really watch it, don't worry about it. Sit it out and wait for a better time. The second thing to really think about with a volatile market is your risk tolerance. Let's go back to the basics. If it makes you really nervous and that $25 stock is going up and down $4 or $5 at a whack, and you don't like that and you can't sleep at night, don't trade this market. It's not worth it. But your risk tolerance has to be solid for you to be able to handle the swings. And before you start to trade a volatile market, you need to think about that risk tolerance and decide how much money you can possibly lose. Make that plan ahead of time and stick to it. It'll save you a lot of grief. But now let's get to actually trading. A volatile market changes things so much because when volatility increases, volume increases. Now, if you're used to trading stocks that aren't high volume stocks, you want to really be careful. They can start to move very quickly. This is why you have to stay on top of them. They can have huge up and down swings in seconds. And you have to be able to stay on top of that as well. But if you're trading a stock that is normally pretty high volume, if that stock starts to swing, you will see huge players in the market. And all of a sudden, that stock's volatility and that stock's volume will just escalate. And what that means is the normal trading speed of that stock escalates with it. And so you're really having to pay attention. You're having to listen to more news. You're having to stay right on top of things. You have to be able to get in and out very, very quickly. Much more so than in your normal trading. If that stock is normally trading its normal volume, you have to be prepared that time speeds up when volatility increases. Now, when I look for stocks to trade during a highly volatile time, I still use my same principles. I still look for stocks that are really solid financially. I still look for stocks that are trending upward, that still have positive guidance, that don't have unusual option activity that may signal something bearish coming down the road. I want to see that increasing at an increasing rate. And then normally I'll pick 3 to 4 of those stocks and trade those almost exclusively as long as they're volatile. Those few stocks in those few sectors, whether they be IT, biotech, whatever, are going to be trading on and off with significant volatility while the overall market is being very volatile. But one thing I do want to caution you about is if you have a few good wins and you make several $1,000s on those wins, one of the temptations is to swing for the fences. And we have talked about this before. You want to put more money in because the thought is, oh man, if I just had more shares, I would have made even more money. And the temptation is to get larger and larger positions in just one stock. And you've got to really, really hold yourself back from doing that. It is very tempting. I'll admit it's very tempting. But it's also very dangerous because if that stock were to take an equally big drop of $5 or $6, it could put you in the hole having earned nothing. That's not worth it. So the same rule about protecting yourself with 3 or 4 or 5 different stocks in your account, even if you have a small account, is still valid, even if you're trading volatile stocks. You can day trade those, you can swing trade those, and make significant gains, but you want to protect yourself from loss as much as you can. Now, I do trade a little bit differently when the market gets volatile. Rather than holding things for weeks or months because the news affects that market so much, I will generally hold the stocks for a shorter period of time. These are all stocks I am holding less than a year anyway. So it doesn't matter if I hold them for a day or hold them for a month, it's the same difference. So what I usually do is I will shorten the time I hold that stock and I really pay attention. I get in, I get out. A lot of times I'll have no positions on at the end of a day. There may be times when I carry a position over 2 or 3 days. But when the market is really volatile, it's rare I would have a position on for more than 2 weeks unless I knew there was going to be, for example, an earnings report come out. And I really was very bullish on that earnings report. Other than that, I don't do that because the market is so swayed by every single thing that your position is going to wildly swing too. And I don't necessarily like those swings all the time. My risk tolerance isn't as high as some other day traders. They have no problem with it. But I kind of do. And so I'm very, very careful. So while I encourage people to take advantage of opportunities, you have to do so in a well thought out, reasoned way that suits your own risk tolerance. And guess what? If it doesn't suit you, get out, and there's nothing wrong with that. Don't ever be afraid to step out. Now, if you've enjoyed this video, please click subscribe, and I'll see you next time.